Hello and welcome back. This is part two of my investing process where we're going to get into my investing checklist. So I'm going to run through all of the points in the checklist with you, give you kind of my reasoning behind each of them and why I think it's necessary to research a stock in depth. And yeah, if you haven't watched the first video, I'd recommend going and watching that now before you continue with this one, just to get you up to speed with the point that we're at in the process. So I won't hang around too much, let's get straight into it. So my investing checklist. So this is it's a series of questions effectively, each of them given points, and it's a total of 100 points. So each stock will get a score out of 100. It's based on two different sections: the financials section, so looking at their numbers, their revenue growth, profits, that type of thing, and the business. So that's kind of like what they actually do, what the management's like, what they're manufacturing, distribution, all that type of thing, the actual running of the business. So two separate sections, 50 points each, a score out of 100. 75 points goes on my watch list. So my watch list is where stocks that I'm allowed to buy when they're at the appropriate valuation. So it's a hard rule. If it's not 75 points, I can't buy it. And I found this very useful just to stop quite often in situations. There'd be a stock that I wasn't quite good enough, but I'd still kind of make a story in my head for a reason to buy it, and I'd get myself into a lot of trouble. So this is a hard and fast rule now. Less than 75 points, I can't buy it. So let's get going. Why do I have a checklist? So it's, as I was just getting onto, I've just alluded to, it's a consistent way to grade stocks. There is some subjectivity in it in the business sector, because you've got to kind of make your own opinions, but as close as you can get to things as complex as companies in the real world, it's a consistent way to grade stocks. It's also easier to compare stocks, especially if they're if they're different, like types of stocks. So you can get a score and then compare like a dividend stock against a fast grower, because they'll balance out on score, because I give points for dividend yields and for growth rates and things, so it balances out. So it makes it a lot easier to compare stocks from different segments and sectors of the stock market. It also takes emotions out of it. As I was just saying, sometimes I can get a bit carried away and buy into a stock just purely because of the story, and not really taking a full enough account of the actual realities of the business. So it takes emotions out of it. If it doesn't get that score, I can't buy it. And it also is a good shield against a lot of common problems that I have experienced and read about that can come up in the stock market. So the rules of the checklist are all designed around preventing common issues, and nearly all the rules actually come from recommendations I've read in lots of books from the greatest investors that there have ever been, and I've collated rules that make sense to me and put them into my own list. So you'll see a lot of similarities here if you've read any of the the common investing books. There's nothing wholly original in here. I've just put together what makes sense for me and applied my point system to it. So the first section is the financials. So I alluded in my first video, in the initial kind of ideas phase, that this can be run through in literally 5 to 10 minutes. And I do this in that initial research stage to check if a stock is worth taking forward to kind of research in more depth and spend a lot more time on. So the first 3 questions are their revenue growth. So I base this on a 5-year compound annual growth rate. So it's looking back over the last 5 years and what is their average growth rate. So I'm looking for companies that are growing. I don't want to invest in companies that are at a standstill, that have reached their peak of growth and don't have any growth ahead of them. So I use Stockopedia. There's many other platforms and softwares out there you can use. You could even just go to the company's website and download their annual reports and things, and you could go back and calculate it all yourself if you want. But it is far easier to use something such as Stockopedia. I'm not sponsored or anything. It's one of my first videos. I don't have any views, so I'm not sponsored or anything. It's just something that I use. So this is an example using Games Workshop. I used Games Workshop as an example in the first video, so I'm going to continue. So it's all kind of continuity. So you can see here that the first row is revenue. So you can look back, and very helpfully, they give a compound annual growth rate average at the end. So that's actually for more than 5 years, but that's fine by me. So it's 16.3%, which is very good. It's an average growth rate. So for all these 3 points, these three questions, I'm pointing at the screen, I don't know why, you can't see that. For these 3 questions here, I give the same points system. So if it's 0 to 10% growth rate over that period, it gets 2 points. 10 to 20%, it gets 4 points. 20+%, it gets 6 points. So there's a scale there, and we're rewarding higher growth rates. So obviously that being 16%, it would get 4 points. It's the same for operating profit over the same period. So we want to make sure that they're not only growing revenues, but they are growing their profits as well. Because they could just be sinking all their money and costs and everything into pumping that revenue growth up, but not actually making any money. So we want to see that growing as well. And that's the same thing, just the row below. And then we also want to see, so that's kind of historical growth. And we also want to get an idea of what their earnings potential looks like in the future. So what I look at is earnings per share growth going forwards over the next 2 years, if I can get the figures for it. So this is based, obviously this is in the future, no one can say with 100% certainty, but you can get analyst consensus. So analysts will analyze the company and give their predictions for what their growth rate will be over the next couple of years. This is sometimes difficult for really small companies because there won't be a lot of analysts, if any, looking at them. But for the larger companies, there'll often be tens of analysts looking at it, and the average score will give you a reasonable idea. And the companies will also give you forward guidance, though sometimes this is only for 1 year ahead, not always 2. But it's the same thing on this. We're looking for an average growth rate for the next 2 years. So you can see here in Games Workshop's case, it's projected to actually fall next year, but then increase by 10.6% in 2025. So the average is single figures, so it would only get 2 points for that. So that's the first section. The next 3 questions are, so we've looked at growth effectively in that stage. Now we're looking at profitability. So the first thing we look at, well, that I look at, is their operating margin for the last 12 months. And the reason I don't look back as an average over kind of the last 5 years is because a lot of things can affect operating margins, and I want to know effectively what they're doing now. Because if they've spent the last few years improving their operating margin, I don't want to have their poor results from 3 years ago affect what they've managed to achieve now. So I look at the trailing 12 months, so effectively what it is currently. So this column is, I'll go back so you can see, this column is, actually on this one it's not, it's normally, they don't have a trailing 12 months, so they've got a current, this is just their last year. But for a lot of stocks you'll get a trailing 12-month column. But if you don't have that, you can use the most recent years. So 36% operating margin, very healthy. And then also at this stage, for a bit more historical context, as you'll notice a trend that in the growth I'm looking at forward and historical, and in the margins, the profits, I try and do a similar thing. So historically I look at return on capital employed. So for those that don't know what all these terms mean, don't worry, I won't do it in this video because it will make it an incredibly long video, but I will do separate videos explaining what all of these things are, like what return on capital employed is, what operating margins. For those that don't know, I will do separate videos on that, so just stay tuned. And if you want to know anything specifically more quickly than that, just put a question in the comments and I'll answer you in the comments as quickly as I can. But yeah, so return on capital employed, so that's effectively, very quickly, the money that they're putting back into the business, what return are they getting on it. So I look at that for the again, the 5-year average. So for them, 66.1%, which is incredibly good. And then I also look at free cash flow per share. So that's the cash at the end of the day, once they've done everything, once they've done all their operations, that is available per share to be spent as the company wishes. So again, on that, I look at it on a 5-year compound annual growth rate. So we're looking for an increasing free cash flow per share rate. So the point system's slightly different on these ones. So 4 and 5 operating margin and return on capital employed. I do 5 to 10, so we don't go down to 0 on this one. I don't want to really be investing in companies where their operating margin is less than 5. So companies like supermarkets and that type of thing have very low operating margins, like 2-3%, and it doesn't give a lot of room for error. If anything goes wrong and they lose 2% of their operating margins, then they can quite easily be in negative territory. So let's see at least 5%. I mean, ideally over 10. That's why we increase the points as we go up. But it's 2 points for 5 to 10, and then the same as the profitability ones, 10 to 24 points and 20 plus 6 points. But we just start a bit higher. And then 6, the free cash flow per share. I'm a bit more lenient on this one because as long as that's improving and growing, I don't mind as much. So 1 to 5 is 2 points, and then I've got a bit of a wider window in the middle. 5 to 20% is 4 points, and 20+% is 6 points. So already, obviously, I'll show you in a couple of slides, but I'll be putting this into a spreadsheet, and already you start to get a bit of a feel for what kind of company it is. Is it a fast grower? Is it a slow grower but got really strong operating margins? All those types of things. And the final 3 questions, so there's 9 questions in the financials checklist. I want to get a very quick idea of their debt levels and how capital and how kind of secure the company is financially in terms of debt. So I look at the liquidity kind of current ratio, and that's effectively all of their assets minus all of their liabilities, just to give a really quick idea of kind of how secure the company is. So again, you can calculate this yourself just by going on and finding their balance sheet and kind of just seeing how many times they can pay off their current liabilities with their current assets. But thankfully, Stockopedia does it all for you. So I just look at this number on the right here. I want to see higher than 1.5 because obviously we want more than 1, that they've got more assets than liabilities, but we also want a bit of a buffer there. So more than 1.5 to 2 points, 2 to 2.5, 4 points, and 2.5 plus means they're incredibly secure, and we give them the bonus of 6 points. So another thing I look at this stage, which is can be quite a big killer of share price performance, is share dilution. So it will give you can look back historically again on lots of things, but here Stockopedia gives you a very useful row here. This is all the same, which is perfect, but this is the number of shares in millions there is each year. So if I go back to here, you can see the years along the top. So for the past several years, it's unchanged. But there'll be some companies that they need to raise funds to grow the business or for investments or acquisitions, and rather than taking out loans, they will just issue more shares. So if you imagine keeping it very simple, for numbers wise, that there's a company that has 10 shares and you own 1 share. If they want to raise money to kind of make an acquisition or just invest in the business, they release another 10 shares, making the total share 20 shares. You did own 10% of the business when there are only 10 shares, and now you only own 5% of the business because you still own 1 share, but there's now 20 in total. So your equity in the business, the amount of the business you own, has gone down. So doubling the shares is quite extreme, but it can happen. There's quite a few companies that it does happen over kind of a 5-year period or a longer period. So you really need to keep an eye on that. And ideally, you'd be looking for those shares reducing, which is share buybacks. So I don't want extreme kind of share growth. So 1 to 5%, 5% is my max. And I'll give them a point if it's below that, because small kind of releases of shares I don't mind for just helping with acquisitions and stuff and making sure the debt's not too high. 0% is ideal, so here they just haven't changed anything, 2 points. And if they're doing share buybacks and reducing the share count, so obviously that would have the opposite effect. It would increase your percentage ownership of the company, then they get 3 points for that. And then finally, dividend yield. So I only will invest in stocks that have growth potential, but I also do give some kind of bonus points to dividend yields because it's always nice to have a dividend paid out as well. So I will give points depending on what the yield is. So 0 to 1.7, 1 point, 1 to 2%, 2 points, 2 to 4%, 3 points, 4 to 6%, 4 points, and if they manage to have a 6% plus dividend, they get a whopping 5 points. So that just helps balance out. If there is a company that's growing but a slow grower, but pays a really good dividend, it could then equal up on points with a fast grower that doesn't pay dividends. And it helps to balance out my portfolio a bit as well if I do that. So those are the 9 questions for the financial checklist. So if we go through, I put all of this, just as I'm going along, running through it, into a spreadsheet that I've made. Very simple, the questions down the side, I just have the points there to remind myself what they are. So I just put the ticker in the top of the company that I'm analysing, so Games Workshop, GAW, and I just go down, and I've set all this up so it calculates it all for me, and I just click the drop down, put the score in that it gets, and it gives me a total. So if it gets 30 points or more at this stage, then it passes the financial checklist and it can go on to the next stage. It's very quick and easy, and this is something that I'm constantly updating as well when earnings and stuff are released as well. So if Games Workshop, hopefully, fingers crossed, it doesn't, this is a stock that I own, it came out and said profits are going to be terrible, like a huge profit warning, revenue's going down, everything's going down, then I would adjust these points and it would have less points. And then if it ended up having less than 75 points total, that would be my sell signal. I'd sell the stock, I'd get out. So this is something I'm constantly updating. And obviously the more stocks are along here, and I just have it all in one place. It's easy to look at and easy to compare. So what I thought I'd just do very quickly is, this is the Stockopedia website. It is a paid subscription, but obviously, as I say, you can get the information from all kinds of places. But this is just, I've just given you screenshots of them, but this is what it looks like. So you just type in GAW in the top, and it will come up with Games Workshop. You click on Games Workshop, and then you go down, and it has all of the data here. This is a paid subscription service, so you have to pay, I can't remember the exact figure, but about £150, £200 a year or something. But in my opinion, it's well worth it, especially if you're researching lots of stocks. And it does a lot more than this as well, but this is just showing you this. So it'll give you handy graphs, and you just go through, and all your figures are here. So all those screenshots I've taken are just from this screen, and it gives you all of the data you could need. Anyway, back to the video. Right, so we've done the first half of the checklist, the quick half. The next half is the business. So this is where I would sit down, and this is where the bulk of the time is going to come in. So it normally takes me, this is very ballpark, it depends on the company, but at least 4 hours, kind of half a day, to just kind of start answering all the questions and things in this section. Obviously it can take longer, and ideally you probably would spend longer, but for me it's finding that balance between you could spend 100 hours just researching one stock and reading all the books on everything related to that company, but I also want to make sure that I get through researching a lot of companies, so I have a reasonable length watch list of stocks that I'm able to buy. So I normally spend about half a day to a day researching a stock at this stage. So I'll read their annual reports, I'll read their most recent trading updates, or kind of listen to their conference calls and things for the most recent results, and watch webcasts. If they've got investor days and things like that, I will often watch them just to get kind of a real good idea of what the company's doing. And I will, obviously this is going to be separate to this 4 hours, but if it's an industry that I'm not too familiar with, then I will try and read some books on it or relevant articles and that type of thing, just to get a broader idea of the industry that they're working in and things. And the idea is to gain, through this stage, a deep understanding of the company, so that I know, well, I'm not always going to know, but have a decent idea of the issues they're going to be facing. I can kind of see when they're going to run into issues and that type of thing. Hopefully, that's the idea. So There's 7 sections to this. Again, it's a total of 50 points, and I put it into a spreadsheet again. So this section is the most kind of subjective, really, I'd say, is just, first question is broadly, do I understand the business? So I'd normally kind of do all my reading and everything and then come through and answer these questions kind of all in one go. But who are the customers and how do they help them? How do they make their money? So where are they actually getting their sales, their revenue and things from? And that sounds like a very simple question, but it can often be a bit more complicated than that. And there's often been times where I've assumed a company's making money one way, but they're actually doing it in a different way. So it's always important to know that precisely and just make sure. What is their manufacturing, supply and distribution setup? I mean, do they do manufacturing? If they're software, they might not be, but how are they distributing and supplying that? And especially for a lot of companies that do have physical products, this is incredibly important. And then who is their competition? Where do they sit in that pecking order? What are the risk factors that they're exposed to? And what are their, so ESG, so their environmental and social and governance. So just what are they doing for the environment? Are they particularly bad or helpful to the environment? What social factors do they have? Are they charitable? Are they helping people out? And are they being kind of sensible and helpful to their workforce? And governance, so is their management respectable? Are they respecting shareholders? Have they got any kind of related party transactions or anything going on that are a bit dodgy? So this section here, these first points that I've just run through would be 3 points, and it's a very easy 3 points. Basically, it's just if I can answer all these questions. So sometimes the company doesn't have enough information for me to thoroughly answer these questions, and in which case it doesn't get the points because they don't have enough information out there. And then another 3 points to make up the total 6 points for this section is, are the accounts okay? So I just read through all the notes in the account, which is in their kind of annual reports and things, which is a very important thing to do, and just check that there's nothing there that's kind of panicking me or worrying me. And if I'm kind of comfortable with their notes and I can answer any questions that may arise, then they'll get 3 points for that. Next would be, so next session is it a scalable business model? As I say, I'm looking to invest in companies that can grow and have a growth runway ahead of them. So this is quite important. So are revenues more than 50% recurring? So they'd get a point for that if it is, just because that gives them a consistent base revenue, which hopefully means that they're not going to have a huge kind of profit warning. They're not going to suddenly fall off a cliff in terms of revenue, and they can build on top of that. So a point for that. Could revenues be scaled 5 times within 10 years? So if their revenue's 10 million, could they make it 50 million inside 10 years? So for a lot of companies, this is going to be a no. But it's a bonus for those really fast, rapidly growing companies. They get an extra couple of points in there. So even though they're fast growers, big companies like Meta probably aren't going to 5 times their revenue in the next 10 years because they're already such a huge company. But smaller growing companies probably have got, ones that are kind of small caps, micro caps, probably have got a chance of doing that as long as they have a clear plan and the demand is there. So is it expensive to acquire new customers? So is sales and marketing, so this is a figure that I've just come up with. I don't think it's kind of an industry standard or anything, it's just one that I've come up with, I probably read it somewhere. The sales and marketing, is it less than 12% of their revenue? Because obviously these smaller growing companies, a lot of time the way that they're growing their revenue is they have to bring in those customers, and the only way they can do that when they're small is by getting eyeballs on them. And to do that they have to spend a lot of money on marketing. So if they're having to do that, I'll dock them. They won't get the point basically. I'll give them a point if they're not having to do that. And do they have the capital, the money needed to scale? Again, if they're a growing company, they need to have the finances available to be able to expand, to build new distribution centres, new manufacturing centres, to invest in R&D, research and development on new products and software and that type of thing. So my check for this is, do they have more cash and short-term investments, so kind of liquid assets they can get and transfer into cash very quickly, than long-term debt? And that's excluding leases. I see leases, I don't see as debt, they're just kind of ongoing business expenses, but then long-term debt that they've taken loans out from banks and things. And if they do have more cash and short-term investments than long-term debt, I'll give them a couple of points. So it's 6 points for this section. The next one is there strong industry growth. So again, you'll notice a theme. This is around growth at the moment. So is the industry that they're in likely to be larger in 10 years? So again, this is quite subjective. A lot of the times this is quite a difficult question to answer, but I just do my best. And if I think that there is, then they'll get 3 points. So obviously AI, the buzzword at the moment, obviously is very likely to be larger in 10 years. So that'd be quite an easy answer. The traditional internal combustion engine, probably not going to be larger in 10 years. I think electric engines and things, electric cars are going to be overtaking the internal combustion engine over the next 10 years. So it probably wouldn't get 3 points. But then you've got the difficulty then of, if there is a company that's mainly making traditional engines, are they going to move into electric vehicles? But you get complications like that, but you just have to make the best judgment. For example, like cigarettes, probably not going to be larger in 10 years. Not that I would invest in a cigarette company, but they're probably not. And things like mining, there may be certain areas of mining for specific metals and minerals that are going to be more useful in the future for modern technologies. But on the whole, I don't think mining is going to be a lot larger in 10 years because there's a limited amount of metals we can get out of the ground. And then secondly, is the industry cyclical or recession-proof? So maybe instead of recession-proof, I should say defensive, because I don't think there's any companies that are truly kind of recession-proof that aren't going to get affected at all if we hit a recession. But more is if it's not a cyclical industry, then it gets a couple of points. And then their future growth prospects specifically about this company. So do they have a clear outlined strategy for growth with definable targets? So I want to see, and it's amazing the amount of companies that don't really have this, written down or in their annual reports and things, a point-by-point strategy for how they're going to grow the business over the next 2, 3, 5, 10 years, and targets for that. So, for example, if it's a restaurant chain, is their target that by 2026 they'll have 500 restaurants open, and at the moment they have 250? So you can see the growth that's going to happen. Or is it kind of a revenue target, by so and so year we will have so and so revenue, which is a growth rate of 15% a year or whatever. So I really like to see definable set targets, because then you can see how the company is doing against those targets, and if they're falling behind those targets after a couple of years, you can make a judgment whether it's worth continuing to hold the stock or not. And it's a lot of the time they won't have these targets. So I give 3 points for this. You'll notice it's normally 2 points, but for some ones I give 3 points and some ones I give 1 point, depending on how important I think that point is. And I think this one's quite important, so it gets an extra point there. Are they innovative? Are they releasing new products or services? So this could be new products to the world, which is obviously very good, and as long as it's in demand, it's going to get growth from that. So for example, like when the iPhone released, yes, it's a phone, but it was a new kind of way of doing the phone, and that took off. And Facebook, when that came out, yes, there had been kind of social media platforms before, but that did it in a kind of a new way, and that took off. It could also be releasing new products for them. So it doesn't have to be a new product to the world, but if they have a line of products that they've been doing the same for the last 5 years, and then they bring out a new product, then that's good, and that counts as well. So for example, looking at Nike the other day, I would count them as releasing new products, because they've released new lines and new ranges of trainers every year, and they do put a lot of money into researching new technologies and things, and new foams and materials and things to make the shoes out of, to make them go faster. So it's not new to the world per se, trainers, running shoes, but they are releasing new products that are going to drive their revenues. And the same can be said for services as well. It doesn't have to be a physical product, it could be services. Will the business be affected by high inflation? And do they have pricing power if they are affected by high inflation? So obviously we've been going through this big issue of kind of ultra inflation for the last few years. Well, I say it's not really ultra inflation, but high inflation for the last few years. And businesses that rely heavily on raw materials, and shipping and kind of transportation around the world have been affected by inflation. So yeah, if a company's particularly exposed to raw materials, energy costs, transportation, that type of thing, because they're going to then be affected by fuel costs, then they won't get the points here. But if they're not, or if they are, but they have pricing power, like they can raise their prices and still retain the same amount of customers, then they would get the points. Get this up here. And then, is growth organic, meaning that they are investing money in their own business and growing their business from within, or is it from acquisitions? So are they going out and buying a company to bolt onto their company to increase revenues? So I'd rather it be organic because they've got more control over that. There's less things that can go wrong, and and it's internally driving. It's a compounding effect there. But I don't mind if there are acquisitions as long as they're successful. So ideally, I'd like it to be 70% plus organic. So this, you just have to go in and kind of look at what acquisitions they've made, look how the revenue changed immediately post that acquisition to see what effect it had, and just kind of work out the percentages. But yeah, if it's mainly organic, I'll give them a couple of points there. And if there have been acquisitions, I just want to go in and check how successful they've been, and kind of what they paid and that type of thing. So I'll just make some notes on the acquisitions they've made, and if I think they've done a good job. Because if they haven't done a good job, then I'm not going to have faith or trust in them making acquisitions in the future. And vice versa, if they have done a good job, then if they are slightly more acquisitive than organic, but they've done a really good job in their past kind of 3 acquisitions, then I'll trust them a bit more and I won't mind so much. So diversification. So this is important both in kind of investing portfolios, but also in the companies you're investing in. So in terms of geographic, so what countries they're in, or customer diversification. So do they operate in multiple countries? Ideally they would do, and that's obviously not always the case, especially with kind of smaller companies that are just starting to grow. But ideally they would, and if a company is kind of a global company that's operating in multiple continents, then that's going to give it a big defensive edge. On a similar note to geography, is a large portion of their business in a risky company. So that could be actual revenues, their customers, or it could be like their suppliers. So for example, a lot of companies will get 90% or 100% of their manufacturing done in China. And that's not I won't invest in that company, but it is something to take in mind, and they won't get the points here for that, because there's a big risk from that, in my opinion, that if that shuts down, where are they going to move their manufacturing to? And that's going to take a lot of time and money, and that's going to be a big hit on the business. And similarly, like if it's for customers, so for example, mines, that's the first thing that comes to mind. Mines operating in kind of Africa and Mali and things, there's a big risk just inherently in being in a kind of politically unstable country like that. Also, is the customer base diversified? So we want there to be the revenue coming from many, many, many different places in terms of customers, not just kind of 1 or 2 big ones. So does any customer make up more than 10% of revenue? If it doesn't, brilliant, that's what we want. And we get 3 points there. So you'll find that there's quite a few businesses, and you'll have to look through the annual reports and the notes, the financial notes often to find this. But they have to say, especially I think US and UK companies, they legally have to say if they have a company that makes up more than 10% of their revenue. So you can just do like a control F when you're looking through the annual report, which is to find and type in single customer or one customer, or 10% often works as well. And you'll find, and they'll have to say, yes, we have a customer that makes up 25% of our revenue or something. And this is just a risk, because if they do have, just put my phone on silent, sorry. Sorry about that, just vibrating away. Because if they do have a company that makes up 25% of the revenue, and then for some reason they lose that customer, either that customer goes to a competitor or it goes bust, then they've just instantly lost 25% of their revenue. And sometimes it can be more extreme than that. I've looked at companies where 50% of their revenue, 60% of their revenue comes from one single customer. And that's a very high concentration of risk. So again, I think that one's quite important, so I'll give 3 points if they're not overly concentrated. Sixth section is, do they have a strong moat? So by a moat is a competitive edge. It's to prevent competitors from taking their business effectively. They're defended. That's why the term moat comes from. This is the company in the middle, and they're protected from competitors because of what they have in their competitive moats. So there's different sections for the different points for this. So do they have strong IP, so intellectual property, patents, or regulatory approvals? So healthcare companies will quite often have regulatory approvals. They have to jump through hoops to get their products to market in a safe way. And tech companies and things will often have patents. A lot of companies will have IP. So, for example, Disney, huge amount of kind of trademarked intellectual property there. You can't just come along. A competitor can't just come along and release kind of a Mickey Mouse film. It's owned by Disney, so that gives them a competitive edge. Do they have a strong brand name with loyal customers? So is their name one that people know about? If someone's kind of, let me just think of an example. If someone's thinking of getting a vacuum cleaner, they might think of Dyson. It has a very strong brand name. And does it have loyal customers? So some people will only wear kind of Nike trainers, for example, going back to an earlier example of Nike. So we just want them to have that competitive edge over their competitors. So is it costly, complicated, or unnecessary for customers to switch? So is it going to cost them a large amount of money to switch to a competitor? Like they have to redo all of the systems or something if it's software that's integrated into their business. Similarly, is it complicated? Is it going to take them a lot of time and effort to make the switch? Or is it just simply unnecessary? Are they providing services that no one else can provide? So they get some points from that, if any of these things are true. And then do they have a durable cost advantage? So this normally comes from just being a large company, from scale. So do they have a large distribution network, either nationally, if they're competing in a kind of a smaller space in one country, or do they have a global distribution network if they're competing on a global scale? Do they have strong supplier relationships, like tactically advantageous physical locations, and do they have a network effect? So any of these things, if they're good in them, will get them some points. And by network effect, I mean, so what that means is that if the number of people that use the product increases, does the value of that product increase? So for example, Facebook or Meta. Facebook, the more people that use Facebook, the higher the value of that product is, because advertisers using it will be able to get their adverts and their eyeballs on to more people. So the more people that use Facebook, the more valuable it becomes. That's what a network effect is. And then finally, the last section to the business section is, do they have good management? And by that I mean management that I believe is going to be good for the business, be able to improve the business, take it forward, and are they trustworthy and reliable and people that I would want to work with in real life? So this is obviously very difficult to kind of judge, even if you've met someone. In fact, never meet any of these people in real life, not yet anyway. But even if you do, it can still be hard to judge what kind of person they are. People can still surprise you, but you just got to get as good a judgment as you can. So this is just reading about their background. There'll be background information on the company's website and in their reports, and just Googling them, seeing if there's any news stories about them, what they've been doing, listening to them on webinars and things, just hearing how they come across and what kind of things they're saying, and reading their letters in annual reports and things. The CEO will always write a statement in annual reports and interim reports. So reading through them and just seeing what kind of things they're saying. And when there are problems that come up, do they deal with them head on and are being honest with the shareholders, or have they in the past tried to hide things and kind of skirt around things and make things seem less important than they are? I'd much rather someone be head on and just be honest about things. So first one, does the CEO, so I focus on the CEO here, they're the ones at the head, so I kind of figure if the CEO is good, then it will kind of trickle down. So does the CEO care about the mission? Do they have relevant industry experience? Are they a founder, or have they been with the company for a long time? And I normally use 10 years as kind of a benchmark for a long time. So all these questions are just to get to make sure that I feel that the right person is in the job. You'll often get someone come in to a new CEO role that doesn't have any relevant industry experience. They've obviously just joined the company. I mean, maybe they do care about the mission, but you can't normally tell that when they've only just joined the company. And often in those cases, people are just, which is fair enough, but people are often just moving around for the paycheck. There's a big salary there, they're going for it, and they're likely to move on in another 3 years when another bigger salary opportunity comes up. I'd rather have someone that's kind of passionate about the company, about the business they're working on, and has been there for 10, 20 years and doesn't have any sign of leaving soon. Is the remuneration fair? So their salary, is that fair? Is the amount they're getting paid fair, in my opinion? Is it in line with their peers? And bonuses and things they have, which I agree, bonuses are fine, but are the targets for those bonuses focused on things that are going to help shareholders, so profits, earning per share growth? I don't want to see it on just revenue growth, because they can inflate revenue without that following down to profits, which are actually what's going to improve the share price and reward shareholders. So I want to see targets focused on financials there. And does the CEO have and the other directors, other executives for that point, but I'll look at the CEO first, do they have a substantial shareholding? So I'd like to see them owning more than 1% of the company, and I have a caveat that more than 100 million, because in some cases, like the mega cap stocks in American things, even if they're holding kind of 0.2%, that can be over 100 million, so that's still a substantial holding. But usually more than 1%, and that just means, in my opinion, they believe in the company. If they're putting a huge amount of their net worth into the company, it shows that they believe in it, and they believe in the long-term prospects of the company, and they're aligned with shareholders. If there's a CEO that's been there for 10 years and only has kind of £100,000 in stock, to me that doesn't say that they believe in the company. If they're not willing to put more of their net worth in, and even just keep their bonuses in their stock bonuses, just to hold those, if they're constantly selling them, that to me says they don't really believe in the future of the company. And is there strong governance? So I touched on this earlier with the ESG, but here's where I actually give some points for it. On the governance front, so I just want to make sure that management is respectable, that they respect shareholders. So this comes back to what I was saying earlier. When they run into issues, are they honest? Are they upfront with the shareholders? And are there any related party transactions that are a bit dodgy? So you'll sometimes see that the CEO's brother or wife owns a business, and they will work with that business, and you can kind of delve in and look at the costs, and it turns out they're actually paying them 10% more than they could be paying another company, and it all gets a bit murky when it's for kind of family and things, and it's just not the best way of respecting shareholders and running the business, in kind of like an honourable way. So I'll look into that, and sometimes that can be quite hard to find, but there's always a section again on related party transactions in reports and things. And that is that's the business section. So you effectively just sit down, read through annual reports, watch kind of webinars, listen to conference calls until you can answer all these questions. Sometimes I'll find that I just can't answer one of the questions. They just don't. The company doesn't have enough information out there, or they haven't answered these particular questions. And in that case, I obviously just don't get the points. So it's the same as the financial score. On the left here, this is just the business score section. I will go through and put the points in, and they'll get a total for business score. And then on this side, so this is what it looks like in my spreadsheet. It's just the same one as I showed you earlier, Games Workshop. This is the financial score, 39. So if it gets past 30, it proceeds, and then I do the business score. And it got 47 for the business score, which is very good. And this gets a total score of 86, which is one of the highest scores I've come across with my kind of checklist. So as I said earlier, put that there so you can see the totals. To go onto my watch list, it has to be over 75 points, 75 or higher. If it's 70 plus, so if it's, for example, 72 points, it won't go on my watch list, but I'll put it on a keep an eye on list. just because to make up kind of 2 or 3 points to get over 75, it could easily be that any of the financials change in the next kind of year or so. So I'll put it on and keep an eye on this. If it's a company that scores 72 that I don't really like, that there's some issues that have come up in researching the business that I'm not keen on, then I'll just drop it. But if it's a business that I quite like, but it's just not quite at the score yet, I'll put it on and keep an eye on this. And if it's below 70, 69 or lower, it's gone. I'll just scrap it, delete it from my lists. Obviously, it will be on here that I have researched it, so I don't have to kind of go through it again. But yeah, it'll be gone. Yeah, so just to summarise, so it's the business score especially, so everything we've just gone through in the last 20 minutes, this section, it's very subjective, obviously. There's not kind of hard and fast like the financials where it's a number, you can't argue it. All of these could be argued. There'll be people that disagree with me on loads of these questions, and that's obviously absolutely fine, and that's what investing is all about. And I'm sure as well, if I go back and research this on different days, I'll probably give different points. There'll be sometimes I think they deserve a point, and sometimes I think they don't, depending on what mood I'm in. So you've got to I try and be quite strict with it. I don't try and just kind of throw points away willy-nilly. I really try and make it so that there's a solid argument that can be made for why they deserve the points, but it is subjective at the end of the day. I update it regularly. As I say, whenever the results come out, I'll see if the financials need updating. The business score gets updated less frequently, but obviously it can do. So if they dramatically change something, for example, if they're a business that only operates in the UK, but they announce that they're going to expand into Europe and other countries, then it'll start to get more points for kind of geographic diversity. Or on the counter, if it comes out that management have done something kind of untrustworthy, a bit dodgy, then they're going to start losing points on the management if they had them before. So they can be changed. It's just less frequent than the financial. And if it drops below 75, it's gone. I'll sell it. I say that. That's what I should do. I have a couple that drop below 75 that I haven't sold. So one of the main difficulties of having a checklist is actually sticking to it once you've made it and following your own rules. But anyway, so for those that don't know, if this is the first video of mine you've watched, I've only been investing in individual stocks for kind of 2 or 3 years. This channel is all about my journey. I'm not coming on saying you should follow me at all. Please don't, because I still don't really know what I'm doing. But so it's too soon to tell if this checklist system will beat the market. But from all of the stuff that I've read and researched over the kind of past 3 years or so, it's the best approximation I can make for a system that works for me. This has gone through lots of iterations. I've changed it lots of times. This is a system that works for me in terms of the amount of research that's required. So it's not crazy, like spending weeks researching one stock, but there's a decent amount in there that I feel that I understand the company when I come to the stage of buying it. And yeah, and I'm excited to find out if this does work over the long term. The system in its current form has only been going about 3 months, so it's obviously far too soon to tell if it's going to be successful or not. It's not financial advice. I probably should have said that earlier in the video. It's just what works for me, so please don't buy any stocks based on this this system. It's not financial advice. I'm not a financial advisor. It's just for entertainment. And my next video will be on portfolio management. In fact, I might change that. It will either be on portfolio management or it will be on when I buy and sell, like how I buy and sell stocks, so my buying rules and my selling rules. I'm not sure which makes sense to come first, but it'll be one of those. It will basically be the next stage in the process. So yeah, I hope you enjoyed that. I hope that was entertaining slash useful for some of you. I'll go back to this slide. And if anyone has any comments, recommendations, questions, anything like that, I'd love to hear from you. I really do enjoy hearing other people's processes. So if you wouldn't mind sharing, please do just put some comments below of what your processes is and how you go about kind of putting stocks on your watch list and things. Do you go more in depth than me, or do you think this is too much work? Do you think I'm going a bit too far here? But yeah, please let me know. If you're not, bit of a plea here. If you're not subscribed, please do consider subscribing. I'm going to be putting out lots of videos. And if I will start doing, once I finish this series, I'll start doing kind of individual stock analysis and things and going through this checklist for companies and reviewing results and things, and I'll be doing lots of other videos as well. So yeah, please drop a like and subscribe, and I hope you all have a great day. I'll see you soon.